What's up, family? This is Simeon the Mortgage Man. You know my motto, everything Simeon touches turns to soul, but today is gold. We're talking about gold. And today I've got someone very special with me. We're going to talk about one of my favorite products in the world, in the country, and that's the all-in-one. If you ever wondered whether there's a smarter way to use a mortgage beyond just making payments, today's conversation is for you. I'm joined by Dave Herbst, a vice president of all-in-one finance with CM Financial, a leader who's helping families across the country rethink how home ownership can create freedom, flexibility, and long-term wealth. Dave is at the forefront of one of the most innovative mortgage products in the nation, the all-in-one, and today we're going to break it down in a way that actually makes sense to you. Dave, welcome and glad to have you, my brother.
Thank you, Simeon. I appreciate it very much. This is exciting.
I know, man. I know this product. I am so excited about what we're going to share today. Get insights about the all-in-one and just what you see and what you've been doing here. So I want to get right into it, Dave. Dave, for those who may not know you, tell us about you and your role as vice president of the all-in-one finance with CMG Financial.
You got it. So I have been in the industry for about 26 years now. 23 of that has been with CMG Financial. And in case your audience is not familiar with those initials, CMG. CMG stands for Christopher Matthew George. And Christopher George is our founder and our president. He founded the company in 1993. We're headquartered out of San Ramon, California. It's east of San Francisco Bay. And, he started back in 1993 with about 7 employees, and today he's grown, and we've all collectively helped grow the company to over 4,000 employees. We're one of the largest lenders in the nation today. I think actually the largest privately held lender in the nation. And my role with the organization has evolved over time. I ran our marketing for some time. I helped build some other business channels. But I've also been part of the development of this program since really day one, which dates all the way back to 2005. We actually were working on it prior to that, but the release of this program that we call the All-in-One Loan was June of 2005. And my role, which really started in 2018 exclusively, was to help expand the program across the nation, create consumer market awareness, and also really update, contemporize the product from a credit standpoint. So I manage all credit policy, a lot of the customer experience and servicing aspect of it, the sales training, of course, and just overall marketing approach with creating consumer awareness.
Man, Dave, I think one of the things why I came to CMG is exactly what you just said. You've been there for quite some time, and retention at CMG is just phenomenal, just to see so many people like yourself that started in one area, but building up another opportunity for CMG just to continue to grow. So, Dave, I got a question. Why do you believe innovation in mortgage lending is so important right now, especially with today's market conditions?
It's an awesome question. And it's a question that needs to be asked, I think, more routinely by people, not just, outside of the industry, but also the industry itself, professionals. And all the reasons why we continue to sort of beat the innovation drum, if you will, today are the same reasons that we were beating the innovation, the mortgage industry needs to innovate drum, if you will, 20, 25 years ago. And, if anything, the market tells the reasons why innovation is necessary. The way we pay and finally, hopefully, own real estate needs to change. And all these tells indicate that the same way they did, back 20 years ago, 25 years ago, they've sort of accelerated into today's environment. We see housing affordability continue to get reduced, or the gap between income and home price continue to get wider and wider and wider. And there's very little relief. The industry tends to, and so does the market. We get used to focusing on things like interest rates, right? Or maybe home prices coming down, and that's certainly, those things help, but those aren't necessarily the root of the problem. The root of the problem is how money is treated how mortgages use money, how a repayment plan is structured and pretty rigid, and frankly unchanged since the 1930s.
30s.
I'd say innovation, yeah, 1938 to be specific, forward amortizing loans were put to market, and for a very good reason. I'm not here to say that they still don't serve a purpose. They do, but I think it's lost upon a lot of people where they don't realize that, the conventional mortgages we're so used to using continuously, obviously the gold standard being a 30-year mortgage. These are products that were developed specifically for first-time home buyers, to really help, post-war era, post-World War II era, post-Depression era, where, housing was used to ignite the economy, stimulate the economy. It was necessary to standardize the banking environment, the lending environment, make it easier to attain. And of course, a lot of that was focused on credit allowances and extending the repayment term from, 5-year balloon, 7-year balloon mortgages, which were essentially unaffordable, to 30 years. And that really helped a lot of people, get into home ownership. I'd say it ignited, middle class, really it created a boon in development in the United States. So it served a purpose. But fast forward to today, here we are in 2026, as you know, Simeon, and things are very different. Everything around you has changed except for the mortgage, it seems. And, and here we are, we're at $14 trillion of mortgage debt in the US. The typical age homeowner with a mortgage is too high. It's 55, 56 years old. Home buyer age, those active in buying real estate annually, is now upwards of about 56 years old. First time home buyer age hit 40 years old for the first time ever. And it just seems like we're heading in the wrong direction. These are tells, these are signs that maybe it's not just, a problem of interest rates being higher, and maybe not just a problem of home prices being higher, but potentially how mortgages treat our money. Maybe we should actually put a magnifying glass to that and consider, innovating the mortgage. And that's what we did. We set out to do long ago.
Oh, man, Dave, that's right on point. Even what we're about to talk about. Let's talk about the all-in-one. What does it stand for, and how does it fundamentally change how homeowners use their mortgage?
Yeah, I mean, simply put, the AIO stands for the all-in-one loan, and it's a trademark brand name that we established long ago, and it's very reflective of the structure of the product. And the structure is pretty simple. It's very unique, but it makes a lot of sense when you really break it down. What we've done is we've merged home financing with personal banking into one financial account. Just take a step back for a second and think about the concept of bundling, services and products together. This is a, everyday normal occurrence with things. We bundle our home and auto insurance to save a few bucks. Well, we bundled the mortgage with a checking account, to help people save a few bucks, and not just a few bucks, but to help use income automatically. The flow of income, deposits and spending, that cash flow in and out of what is likely somebody's biggest, strongest financial account, in order to offset not just the principal balance, but the amount of interest that somebody has to pay on their mortgage. And if we can help people reduce the amount they have to pay for a home loan, and again, not just by a few bucks, and not just by a couple $100s, but potentially by tens of thousands, maybe even hundreds of thousands of dollars, completely avoided in interest cost. Well, then we just put people in a better spot. They get to retain more of their income. And what would you do with more income? What would you do with an extra $50,000 or $100,000 of money you've already earned but didn't have to spend on your mortgage? I mean, what we've been achieving is strengthening the housing market through this product. And again, it's a very simple concept. People that can qualify for mortgage, it means that they work, they earn, they have the ability to repay that debt, and that's how we approve them. But after that, when we close a conventional mortgage, the entirety of their income that we use to qualify doesn't have any meaning, as long as they take just a small portion of that and apply it to their monthly payment. Well, the all-in-one loan is different. The deposit account, the checking account that's built into the mortgage itself, allows deposits to pay down principal the day that those dollars are earned. So imagine earning a paycheck today and your mortgage balance dropped by your paycheck today. It's gratifying. And that offsets monthly interest payments and annual interest cost.
Oh man, that does. I mean, just the concept itself. Imagine you on a 30-year fix and looking at that balance go nowhere the first 10 or 15 years. And then I think
It does take about, that's right, 19 to 20 years or so, even at today's rates or even at
right.
COVID era interest rates, before your payment turns to mostly principal versus interest. And see, I mean, people generally don't stay with their same mortgage for that
No.
long. They generally, historically speaking, about every 5 to 7 years, get a new one for whatever reason, refinance, or maybe they sell that home and get another one. But we are constantly restarting the payment clock, and
Right.
that's what we intend to stop. What if you just got the last loan you ever needed? The very first loan you got on a home was also the last loan you ever needed for that home,
Right.
and it accelerated pay down to the to an average pace of maybe 8-year payoff. That's exciting for people because I think it's much easier to see and plan for. 8 years is much easier and much more exciting than 30 years.
Exactly. No, that's man, Dave. That's so good because so many people, when I talk to them, and they want to talk to me about rates and can I beat this rate? Can I beat this rate? Well, the first question I ask them, what's the goal here? Are you literally trying to start over and pay all this interest, or are you interested in paying off your mortgage? And that gets their attention too, as well. And I think one of the questions
Yeah,
I
I
asked that you brought up too was the biggest asset. I always ask people, what's the biggest asset? They tell me everything about their house. I say, no, it's actually your checking account.
yeah, brilliant. I mean, it's absolutely true. Statistically, people will flow or earn and manage more money through their personal checking account
Mm-hmm.
in just 5 years than the amount that they owe on their mortgage loan. So, why does it take us 30, 40, 50, 60, or never at all, to pay off a loan, a home loan? The average duration left on a home loan today in the United States is about 25 years,
Wow.
and the average age mortgage borrower is 55. So we're looking at a massive housing market that owes $14 trillion collectively, and the vast
Right.
majority of them will not make their last payment until they're well into their 80s. That's
Right.
if they stick with the exact same loan, and that has an impact. So what does that slow down? What other areas of your financial life does that impede? Well, retirement is one of them. I mean, by all means, most people are not able to save enough these days for future needs.
Mm-hmm.
And nobody's talking about how the mortgage plays a role in that process, except
Right.
us, it seems. We've written white papers and we write monthly articles on this topic. And it's a very simple concept.
Yeah.
The mortgage is life's largest expense and it consumes the most amount of income dollars. Let's make it more affordable. Let's make it less expensive. And the way you do that is just by using your income.
Right. Right. Man, Dave, you're hitting on points, particularly when it comes to our industry. Nobody talks to you about how to pay off your mortgage, but most lenders
That's right.
keep you in a mortgage. So it's just the opposite. Let me ask you a question too, on something you said earlier. What's the biggest misconception people have when they hear a
Mhm.
line of credit or a non-traditional mortgage?
Yeah. And you're right. That's, so the all-in-one loan, the mortgage side of the all-in-one loan is a line of credit. It's a 30-year term, first lien position line of credit, and otherwise known as an open-end mortgage. That's what a HELOC or a line of credit is. So it allows somebody to put money into it and take money out of it without having to refinance.
Right.
That's the benefit of open-end financing, of course. But generally speaking, open-end financing or HELOCs are put in place in second lien position, and they sort of restrict your access and your utility of it to about 10 years on average. And we built this to provide our customers access to their money for full 30 years, which is extraordinary. And to your question, I think the biggest misconception about anything alternative to traditional financing and a traditional 30-year loan is that it's risky. I think people are very used to sort of almost robotically, believe that, standard 30-year financing
Mm-hmm.
is the safest way to pay for real estate and borrow money. And while it is suitable for those that, are newly establishing their budget,
Right.
it can also impede financial progress with a lot of our
Mm-hmm.
market. Tens of millions of people more are sort of slowed down because of the repayment schedule, the amortization that comes with those mortgages. So with the all-in-one loan, what we do is we achieve accelerated pay down with using money that somebody has already earned automatically with no change to their budget or lifestyle.
Right.
And that offsets a lot of interest costs. So you just don't have to pay and you get to retain more of your income, build equity in a property faster, everything everybody would want. Um, And, but I think again, like to your point, anytime you begin talking about something different than this standard conventional financing, the misconception is that it must be risky, that there's a catch, that there's
Right.
something, some sort of devil in the detail they need to be aware of. And, it's not. This loan is not a great fit for everybody,
Everybody.
and
Mm-hmm.
nor should any product be sort of treated that way.
Mm-hmm.
What we do, as you know, is we analyze, suitability and test suitability and financial benefit compared to traditional financing to make sure that what we're putting in place is actually going to, be a significant benefit. And we won't do this loan if it isn't. And it's very clear to us. We have forecasting tools, of course, that you're aware of and that are used in that process. So
Right.
I think it begins there. It's about risk. Is this riskier? No, we actually have no foreclosures on this loan.
Yeah.
It proves to be safer because it reduces your debt faster. And that puts us both,
Say that one
lender
more
and
time, Dave. Say
borrower.
that one more time, Dave.
Yeah, it's worth. Let's brag about it, baby.
Uh-huh.
No foreclosures on this loan. It reduces risk in owing money, and frankly reduces risk for us as a lender in lending money.
Right.
And let me just kind of qualify that. If you owe less on your mortgage relative to what your home is valued at, then that simply puts both parties in a better position.
Mm-hmm.
Right. And so instead of delaying your pay down, we should, as an industry, be working on helping people get out from underneath the debt faster and smoothly with no
Mm-hmm.
disruption in their lifestyle.
Oh, that's good, Dave. Dave, can you repeat how long is the all-in-one? It's good for how long again? Did you say 30 years?
Yeah, it's a first, yeah, 30 up to 30 years. That's right. So we
Mm,
have two versions of the loan. And for any of your listeners that are in the state of Texas, Texas has some
right.
very unique laws down there as it relates to use of home equity money. So for the all-in-one loan that's applied to a primary residence in the state of Texas only, it's a 25-year accessible line of credit, and everywhere else, it's a 30-year line of credit. So imagine getting paid. Your paychecks. That could be self-employed income that you're paying yourself. Could
Mm-hmm.
be just your regular wages, bonus, any receivables, commissions, whatever you normally deposit into your standard checking account, you would deposit into your all-in-one loan checking account. And that deposit, any amount of money at any frequency, goes directly to loan principal. Even if you need to spend those dollars or some of those dollars in tomorrow or in a few days, while you're not spending those dollars, it's keeping your daily interest costs lower.
Right.
And each day gets its own unique interest calculation. And so, we've created a mechanism to help people engage the debt using their income automatically
Mm-hmm.
and, offset the cost they're going to be subject to.
Yeah, man, that's so good because if you think about it, so many people come to me, Dave, asking how can they access the equity, but here we're talking about not only
Yeah,
paying your mortgage off, we're telling you you have access to write checks for any
that's right.
reason from the all-in-one. So that goes to how does
Yeah,
cash flow?
don't.
Go ahead, Dave.
I was going to say, just don't, what's great about it is you're not advocating tapping into your savings account or your 401k account or
Correct.
emergency fund money you have for, medical things to go repair your roof.
Mm-hmm.
Instead you can write a check from your mortgage and you're using the money you applied towards it. For the last 12 months, all that payment money on a regular mortgage, it's stored there permanently. It's in mortgage prison.
Right.
Otherwise, you'd have to go get a new mortgage or you'd have
Did
to
you
go get a
say
second
mortgage
lien
prison? Did
typically.
you just say mortgage
Yeah, I said
prison?
mortgage prison.
Yeah, yeah. That's good.
You can use that. Where does your money go? Now it's in mortgage prison, and you
I
can't free it
know.
out unless you go get another mortgage,
Right.
and that stinks. So
Right.
this just makes it easier because you're liquid 24/7.
Right. I love the word liquid. So, how does cash flow management play a role in building long term wealth through home ownership?
Yeah, it's our goal to help people recognize that at the end of the day, net worth, growing your net worth is achievable. And it's, of course, what everybody wants. And I think when people think about wealth, they think about simply and only investing. So growing assets by, allocating money and investing in the market. Um, and, you can also grow your net worth by reducing your exposure to interest costs. The old
Mm-hmm.
adage, a penny saved is a penny earned,
Darn.
holds true when you have a mechanism like the all-in-one loan. And let me give an
Mm-hmm.
example. If if I used my all-in-one loan and in the year 2026, and by the way, I am a customer. I've had nothing but all-in-one loans on my real estate since 2005, just in case anybody's wondering. Uh,
Wow.
if I saved $15,000 in interest cost compared to a traditional loan this year, just by using my all-in-one loan, that's a real tangible benefit. Those dollars remain liquid for my use, everyday normal use if I need to pull them back out. But if I avoided $15,000 in interest costs compared to a traditional mortgage, then it puts me in a better place. If I keep those dollars there, I continue to compound my benefit year after year, month after month. Now, if I instead took $15,000 and I invested it and I earned a yield back at a decent interest rate, that's a taxable event. So let's say I'm saving mortgage interest at 6%. Let's say my all-in-one loan is at 6%, or I invested those same dollars and I yielded 6%. Well, in my investment, I would have to pay tax on that gain. So, really what I'd be getting is probably closer to 4%, potentially. Where in the all-in-one loan, you're not taxed by avoiding interest costs. You've already
Right.
paid interest on those dollars when you earn them. So, cash flow management matters, especially when you're, allocating those dollars towards a debt instrument like the all-in-one loan that can help develop or grow and accelerate net worth, net worth, household net worth. And that's sort of a different paradigm for people. Reducing
Right.
your debt and your exposure to interest cost on debt grows your wealth. It grows your net worth.
Correct.
You don't always have to take risk and put your money in the market. You can use a debt mechanism like the all-in-one loan to do that too.
Yeah, and not even changing your habits. You're still depositing the money just like any other checking account that you deposit
That's
money
right.
in. Yeah, that's great. And
Mhm.
here's the other thing too, I like, Dave, that we haven't mentioned, but as you very well know, the all-in-one applies to your primary resident, to your investment property, and a second home. So it allows you
That's right.
to look at that. But in addition to what I always tell my clients, hey, look, through the all-in-one, when you pay your mortgage off or pay it down, you're able to use that same all-in-one funds to buy another real estate property without coming
That-
to me again. So it's
yeah,
just
yeah, and you can do it faster. That's right.
correct. Correct.
you 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 end up sort of functioning as your own bank. I mean, it's really
Right.
sort of a slogan or a tagline we used to, and you can use this too, my friend. Be the bank of you.
Right.
Don't let others, right, manage your money. You should be benefiting from your hard-earned dollars more so than anybody else. And the way you do that is by using a mechanism like this. And if that's a question, just by listening, oftentimes we do get this question, because people are skeptics, I think, naturally, and they should be,
Right.
especially when it comes to financial products they've never heard of before. We get that. Just in case somebody's wondering, does CMG Financial leverage deposits the same way a traditional bank does with their bank accounts? No. When a deposit is received in an all-in-one loan checking account, it literally is curtailed. It curtails principal, meaning it sweeps and is applied to the loan balance,
Hmm.
paying it down. And because it's a line of credit, it keeps those dollars available 24/7. So, our hands aren't on those dollars. They are literally going to pay down the mortgage balance, and
Mortgage.
they're not available for, us or our bank to use to go make more loans. That's the traditional bank model. There's nothing wrong with that. It's just not our model.
All right. Man, that's so good, man. It's so good for those who are listening. They're really hearing a lot of questions that are asked to me as well. You're answering those questions. And since
Good.
we're talking about the all-in-one, there's another product I love too, Dave. One of the things that really separates the all-in-one is the traditional lending is that we have a construction option. Can you talk about the
That's right.
all-in-one construction option and what's so
Yeah.
favorable about that too as well?
For families that are looking to build a new home, a new custom or semi-custom home, it's that's kind of the essence of the American dream. If you think about it, right, is really, can you imagine buying a chunk of land and working with an architect and a builder to plan out, your forever home? I think we can all identify with that dream. So for those of you that are listening might be in the market to do that in the future, so we developed this exact same product into a construction loan, and it's what that means is it finances the builder's needs, as they construct the home according to the plan that you've signed off on, and it's the exact same benefits that I just described here momentarily ago with the line of credit. But the greatest thing about this loan is it's a one-time close. Unlike most traditional construction products, you have to requalify, right?
Right.
And there's some sort of modification segment to it where you're getting sort of a second loan built into it. That's not the case with this. It's a first lien position, 30-year draw, line of credit that funds the construction, and you only qualify once. We only underwrite once. We only close once.
Mm-hmm.
And the funds for construction, according to the builder's schedule, it's called a draw schedule to construct the home according to their plans. We will finance that or fund those each milestone through the line of credit. So as the builder requests an advance for work completed, we fund the builder directly from the borrower's line of credit, and we do that until construction is completed. And once it's completed, there's no modification, no re-underwrite or anything like that. The customer has full access to their line of credit.
Right.
And as soon as that process begins, the customer gets the checking account, and the checking account linked to their line of credit means that they can start using their income and their cash flow, pay their bills from their mortgage, and build equity in their property even before it's completed.
Right.
So, and that's the way people use it. And we've had this out for about 2 years now. People are building equity in their home without it even being completed on their land. And it's really gratifying. And all that money that they create in equity is liquid to them over that 30-year term.
Right.
So they can, finish off the hardscape, furnish it. They're liquid. They have resources through the loan to continue to use it, to make sure that that finished product, that home, is exactly how they wanted it.
That's an incredible product that CMG offers with that all-in-one and new construction home. When I first heard that,
Yeah.
I was just screaming like, "Man, this is awesome!" So no,
Yeah,
thanks, Dave.
you're welcome.
I wanted to ask you too, as well, for the acquisition of and development of Bank CMG. What other
Mhm.
enhancements do you see with the all-in-one loan? What do you see in the
Yeah.
future with the all-in-one?
Yeah, this is going to be very exciting for us. The development of Bank CMG is a large initiative, one of our primary initiatives, within the organization in total. And one of the components to that development is the eventual servicing piece for the all-in-one loan, an enhanced experience for the customer. Simeon, what we're going to do is we're going to really kind of shake up the way people engage debt. We're going to create reasons for people to want this loan, just also through the servicing aspect of it, the insights that they're going to have access to. This is one of the key features to the product, is understanding your trajectory, not just payoff trajectory, but net worth development trajectory.
Right.
So in terms of everything somebody's doing with their cash management, their investments and other debts, are you on track to meet your goals, whether that's to retire in 6 years or 16 years or 26 years, or to pay off your house in 4 years or 14 years, whether to save enough money to send your kids to college without having to take out a student loan and get further into debt. All these goals combined are going to be, you'll have visibility, and you'll be able to set these goals in our servicing hub attached to the all-in-one loan, and it'll measure that daily, so that it keeps people engaged in the know with where they're headed. Because I think a lot of people just frankly don't know where they're headed financially, where they're going to land, how much money they're going to have by the time they're hoping to retire. So this is going to create those insights, and you'll be able to adjust those your goals routinely. So if you wanted to retire in 8 years, you'll be able to tell the mechanism, your servicing portal, hey, I'd like to have this paid off in 7 years so I can meet my retirement goal. It'll tell you exactly what you need to do in order to achieve that, rather than sort of flying blind. And it's those types of insights that are going to be really exciting. Also, imagine this: imagine swiping your all-in-one loan ATM debit Visa card at the gas pump because you're filling up your car with some gas, and you get a notification on your on your phone that from your account. This is that $100 obviously was spent, and that delayed your payoff by 2 days and 6 hours. But the
Hmm.
good news is you're still 25% on track to, ahead of schedule potentially to have your home paid off by the time you're, 42 and not 82. I mean,
Exactly.
this is what we want. Yeah, we want to encourage and incentivize people to, essentially be better stewards of their income and their cash flow. And the best way you can do that is by creating insights, making it visible to them where they're headed and giving recommendations about what they can do to improve their trajectory. That's
Hmm.
what's missing in debt management. Nobody talks like that. Nobody
Nobody.
develops
Right.
platforms. Nobody. We focused it. There's a lot of innovation like that, that's applied to investing, but not debt management. And this is what we intend to change, in the
Hmm.
U.S. and change the way people think and about their own money and what they can do with it. Remember, most people will earn more money in 5 years than they owe on their mortgage. So let's put those dollars to work. Let's make them work for you and, get out of debt, create some liquidity, more equity, and less dependency on things like, that we don't control, like interest rates
Right.
or home prices. These
Right.
are market variables that none of us control, but we're subject to. At the end of the day, that's not the answer. The answer is to innovate, you know, debt, debt mechanisms or, things like the mortgage and, uh, allow them to treat our money better. And that's what we set out to do. And that's what it does.
Yeah, no, Dave, that's right on point because so many people that I talk to, they're more interested in how much they can save on a 30 or 40-year fixed rate, and I'm telling them, hey, are you more concerned with saving $100 or paying off your mortgage? And then I get their attention
Yeah.
because it allows them to. We're so conditioned with the 30-year fix that most people are not talking about what you just explained. How
Yeah.
Bank CMG is going to allow us to start projecting these things and helping that age group that you
That's right.
said that still have 25 years left on their mortgage. So man, that is
That's
super
right.
awesome. It's super exciting too as
Yeah,
well. So Dale,
it is. It
I want to
is.
I want to ask this last question. If someone is watching this and wondering whether the all-in-one loan could change their financial future, what would you encourage them to do next?
Well, they got to reach out to you. I mean,
Oh.
let's just be frank. They got to reach out to you. They have to ask some questions. It's look, the good thing about this loan is that it's not a sales job. We don't sell, as you know, we don't sell. This is about education and just informing people. Just allowing people to understand that this is an option for them, and then of course, working with an expert, some of this experience with the product like yourself, and just analyzing, their behavior, what they need to qualify for. There's two sides of this: the all-in-one loan and the all-in-one loan approach. There's the qualifying side of it, which of course exists with any mortgage product, any loan that you're applying for. You've got to qualify for, and this is really no more difficult to qualify for than a standard 30-year fixed mortgage. In fact, it's sometimes even easier, given some of the nuance, credit allowances, especially for great savers. And then there's the suitability test, like what product is going to match your goals, near term, long term goals, the best, and is this going to achieve that, in a more efficient manner, uh, compared to traditional financing? And so that suitability test is done through a forecasting tool that we call our interactive comparison simulator, and that's online, just by
Mhm.
going to the website allinOneLoan.com, and of course through your team's pages as well.
Right.
That can be accessed, and it's very easy to use and to run. But here's what I encourage people to do: is reach out to the CMG financial CMG home loans expert in your area, or of course Simeon's team here. Information on screen, and just have a conversation. What's more important to you: the interest rate that comes with your loan, or the amount you have to pay for it? And if you're interested in paying the least amount for a mortgage, which I believe everybody listening probably is,
Hmm.
rate is just one component to the
Right.
mathematical equation. It's not everything. You can't compute cost just on rate alone. You have
Hmm.
to also focus on principal balance and time that you owe principal. And the all-in loan prioritizes principal and time, so that rate can matter a lot less. And
Hmm.
I'm not saying that the rate on the all-in loan is high or higher. I'm just saying that prioritizing what's really important is what the all-in loan is engineered to do. And I just encourage everybody to have a conversation with a trusted professional, regarding this loan that's an expert at it.
Right, right. Come on, you know that professional would be Simeon the mortgage man.
That's right. That's right.
But the greatest thing, even with us, your team does an excellent job with communicating with our future borrowers and those who are about to close. We have so many safeguards and so
Yeah.
many instructional portions of this loan that prepare people for this mortgage and walk them through it. So it's, man, I love
That's
what
right.
we do on making sure our customers are
No, I
comfortable.
appreciate you saying that. Yeah.
Yeah,
Yeah.
man,
I
it's
think
awesome.
it's extraordinary.
Mm-hmm.
Yeah, I think we take extra steps, and I don't
Yeah,
know that any other lender does that. It's we the right product at the right time in somebody's life for the right reasons is really our internal mantra. And the greatest thing about the all-in loan too is it sort of tailors the outcome. Like the results of the all-in loan, weekly are based on how you use it. And the more you use it, the more you engage it, the better it gets, and the easier it is to repay the debt itself.
right,
And that's because it reduces monthly payments, it reduces your monthly costs automatically, ongoingly. As you pay down principal, your payments reduce automatically. That's
right,
far better than having the same payment throughout the life of a loan, no matter how much money you put towards it. This just improves lives. And the more you engage it, the better it gets. But yeah, we take those extra steps to make sure that every single customer understands how it works, and
right.
they get excited, and we're available to them to answer questions even before they close. It's an
Correct.
extraordinary step.
No, it's just it's so awesome just to have a staff and your team that helps me not only prepare my clients but also the simulator. The simulator explains
Yeah.
why we do what we do. It
Mhm.
analyzes your expenses. It analyzes all those things. It analyzes your taxes, insurance. It does everything to help you make
Yeah,
a wise decision on how to
that's
remove
right.
your mortgage debt. So no, thank
That's right.
so that's powerful, and this is exactly what education matters when it comes to home ownership to me, Dave. Family, the truth
Mhm.
is, you may already have options you don't even know that exist. Whether you're buying, refinancing, or sitting on equity, the strategy matters just as much as the rate, as Dave has been saying. If today's
Mhm.
conversation sparks something for you, don't sit on the sidelines. Call Simeon the Mortgage Man, 314-565-3254, and let's tailor a plan that fits your goals, and not only one size fits all with this mortgage. Dave, thank you for your leadership and your heart for helping families. Until next time, this is Simeon the Mortgage Man, and let's make your mortgage work for you.